Okay, so hello and welcome everybody. Thank you for joining us today for our webinar, R&D tax claims after the resets, re-examining eligibility, evidence, costs and benefits. I'm Suze, Commercial Director here at WhisperClaims, and your host for today is Jen Badger, our co-founder, MD and overall R&D tax subject expert. Hello, Jen.
Hey.
Okay, so we have chosen a back to basics type theme for this webinar and the next couple that we'll be doing, and some of the content that we'll be sharing over the next few weeks and months very deliberately. Over the last couple of years, a lot has changed in R&D tax with new schemes, new processes, and much, much more scrutiny. But what hasn't changed are the fundamentals HMRC continues to assess every claim against. So in many ways, everything has changed, but nothing has changed. Eligibility, technical evidence, cost treatments, and benefit explanations are not new concepts. But now that the merged scheme has had time to bed in, firms are finding it useful to take a step back and revisit how consistently and clearly the fundamentals are being applied in practice. So our intention today is to bring the core building blocks of claim preparation back into focus in the context of an environment where claims are more likely to be reviewed and questions are more likely to be asked. The overall aim is to support confidence so that firms can continue to prepare claims knowing their approach will stand up to review if challenged. That is really something that we talk about quite a lot in everything that we do in terms of our content. So for those of you, sorry, that don't know us, I'll just briefly say that we are WhisperClaims. We do not prepare claims. We support accountants and advisors with a structured compliant first framework and expert advice line support so they can deliver claims and tax advice in-house. Before I hand over to Jen, just a quick note to say that we'll be running a couple of polls during the session today. They're completely optional, but we would love your participation if possible. There's no right or wrong answers for any of the questions that we're asking. They're simply a way to help us all share and understand how firms are approaching some of the areas that we'll be discussing, and to highlight that no one is dealing with any of these questions in isolation. We'll also have a Q&A at the end, so please do feel free to pop any questions that you have in the Q&A box. I'll be sharing some resources in the chat, so if possible, do avoid there for questions. If a question does find itself in there, that's absolutely fine. We just don't want to miss anything. Over to you, Jen.
Thanks, Suze. Yeah, so just a quick run through what we'll be covering. Suze has covered the introductions, so I'm just going to touch on eligibility, technical narratives, the eligible costs, how we calculate the benefit, and then we'll jump into the Q&A. So I will say that putting this webinar together was an interesting process for me. Obviously, I've been doing this for a very long time. I know our app inside out, and we've done a lot of work in the app to update it to comply with all the new rules. And yet I still found myself going and looking up certain aspects of the fundamentals because I haven't thought about them deeply in such a long time. And I think that was really the feel we had when putting this webinar together, is that there's been so much talk, so much training material, publications, everything about all of the changes. I think we've all neglected to really think about the fundamentals and how they haven't changed. So when I was thinking about it, we've used the phrase a changed landscape a lot over the last few years, changing and now changed, but it's still familiar. You know, we haven't gone from the Arctic to the tundra. Tundra is still quite Arctic, the Arctic to the savannah. We're still in a familiar landscape. There's still quite a lot there that hasn't changed and underpins everything we do. Having said that, let's just do a quick summary of where we are now. So currently, and I keep having to do the thinking of like all the dates of this, but we still for another year will be thinking about 6 different schemes all at the same time. So obviously we have the new RDEC ERIS and Northern Irish ERIS that are part of the merged scheme, and then we have the old SME scheme, old RDEC, and the R&D intensive scheme, which the final claims on that will time out sort of March next year. So we're still juggling all these different schemes, so we have to think about them all. And I'll try and make sure that at any point during this webinar, if we touch on something that isn't the same across all of the schemes, I'll make sure to highlight that. Key things to take from this is just that obviously the claim years we're talking about, anything that starts on or after 1st of April 2024, we're looking at merged schemes, so it'll either be new RDEC ERIS or Northern Irish ERIS. Anything starting before the 1st of April 2024 will be SME scheme and old RDEC, and then obviously there's a small window of claims that fall under the R&D intensive scheme. I'm not going to go through this in detail because in the end, what we want to talk about is the similarities, not the differences, but this does sum up kind of all the differences across those 6 different schemes that we are now working with. So I'm going to take a pause for a moment while Suze puts up our first poll.
Let me try to make sure that we can get that launched. Jen, if you can tell me if you can see it, okay, that
Yes,
was
I
awesome.
can.
Okay, so as I said, your participation would be greatly appreciated. This is just a quick poll just to find out how confident are you that eligibility decisions are being applied consistently across your firm's claims. So we've got very confident, clear, documented approach, reasonably. You're reliant on individual judgment, which is absolutely fine. Mixed, you've got a variety of consistency versus, from team member to team member, maybe, or claim to claim. Or maybe this is an area that you are actively reviewing, which is obviously a really good place to be as well. I'll just give you a couple of seconds to all pop your answers in there. Got the second option, reasonably confident, is trending well. It's a very common position to be in. Obviously, professional judgment and experience is very important. You know your clients and businesses best. Is that everybody? I think that's everybody decided to add in their position. That's great. I'm just going to take a quick screenshot of that, just if you hear my my Zoom go, just for our follow up later on. Okay, thanks everyone. I'll end the poll there. Jen, is there anything you'd like to mention about the results you can see there?
No, I think that's what we'd expect to see, obviously, from a self-selecting group of people that are interested in R&D. It's good to see that most people feel reasonably confident. Obviously, there are people, and I think it's good to be honest as well about this as an area you need to review or that you're worried about. Obviously, there are many things you can do to help with the confidence, and that's what we're trying to do today. But it's good to see that most people are feeling okay about things at this point. So that's good. Okay, so going to dive quickly into eligibility now. Obviously, I'm covering, it's a huge subject, all of this. I realize I normally do this as a 2 and a bit hour training course, so I've condensed everything into a, call it half an hour webinar. So I won't be going into anything in any detail, but the resources that Suze will share as I go along will go into things in a lot more detail. And obviously our training course is available if anyone wants to have more of a deep dive into everything. But the key things for eligibility for R&D tax relief. So if you're looking at any piece of work done by your clients within a company, number one thing, it needs to be carried out as part of a project. So I won't again go into detail about what HMRC would count as a project, but you are looking for things that are done where there's an aim in mind. They're seeking to make it in advance, and there's a kind of tangible start and end point of that work. That basically, that requirement from HMRC precludes that kind of ongoing tweaking and optimization that all companies do of like, oh, I wonder if I just do this for 10 more minutes, or if I change the setting on the machine, or if I do it that way, or that kind of thing. They don't want that ongoing tweaking to be part of your R&D tax relief claim. Obviously, it has to be undertaken during the claim period. I say this in other training courses, then I have to add a small caveat that there are some niche situations where that is not true, but generally speaking, the work has to be done during the claim period and the costs have to be incurred. It has to be related to the trade of the claimant company, so either the trade they're doing now or will carry out in future. It has to be aiming to make an advance in science and technology, and I will cover in more detail what an advance is. It has to involve the resolution of technological uncertainties, and it has to be not readily deducible. And the key thing with all those points is none of those have changed significantly in recent years. So these are the absolute bedrock of your R&D claim, and they haven't changed. Nothing about how you would assess the eligibility of a company has really changed at all with any of the new schemes, anything that's come in. The one thing that I would say HMRC have changed focus on, maybe it's always been a thing that they need, is baselines. So there's always been a need to describe the baseline the baseline of the project, the baseline status of the science and technology before the project started. What has happened, obviously, is with the introduction of the additional information form, HMRC have overtly been asking for that, when maybe before, because there was no standard structure for the information, this wasn't something they pushed for as much. But it's absolutely vital now, obviously, being one of the boxes in the additional information form. And I have come around to saying that you have to pin down the baseline before you can think about anything else, because the baseline is what was technically possible at the start of the project. If you don't know the baseline, you can't know what the advance was. If you can't articulate where you started, you can't then articulate where you're going or where you've got to. So the baseline is incredibly important. Again, with the uncertainties, if you don't know that route that goes from baseline to advanced, you can't talk about where the uncertainties were because you can't talk about at what point on that journey did your client encounter them. So again, it's key to that. And the resolutions are key because you have to talk about how you got from that baseline in a kind of physical, practical way, how that can. So baselines are incredibly important and are forming something I would say that some HMRC are, focusing more on. So yeah, you cannot articulate the advance without first understanding and describing the baseline. So they need to understand what's been advanced, and to know something has moved forward, you need to know where it started. So baselines are key. And then advances. Advances are second only to uncertainties and probably the most difficult thing to understand and articulate, and also incredibly important in proving to HMRC that the work is valid. So the advance essentially is knowledge generated during the project that goes above and beyond the baseline. So immediately you have to have a baseline. You need to be able to say, this is what was possible. This is what the science was capable of doing. This is what the technology was capable of doing. This is the knowledge we had. And this is what we did. This is how we generated new knowledge in that area. Anyone that is at all familiar with CIRD or the other, I can never remember what they call them now, but the guidelines knows there's four main types of advance. So you've got work that seeks to extend overall knowledge in the field of science and technology. I always describe this as more of the blue sky research. This is more your university spin-off companies or your really large companies with large R&D budgets. But basically, they're going, we need to just generate some knowledge. There's no real practical application at the moment. The second one is work that seeks to create a process, material, device, product, or service that incorporates an increase in overall technology. So again, that's taking that blue sky research and turning it into something commercial, taking that new knowledge, that new capability, that new advance. I would bring AI in here as an example, but to be honest, AI has gone very quickly through to the other side where it's probably not hugely eligible anymore. But the initial projects that used AI to do something new would have been eligible. Third one is the one that I would say covers 80% of the R&D that's claimed for, and that's work that seeks to make an improvement in an existing process, material, device, or service through scientific or technological change. So that's you're making things faster, stronger, lighter, more environmentally friendly, cheaper, whatever it is, making an appreciable improvement through scientific or technological change. And when I talk about this, the key thing is that it's scientific or technological change. It's not swapping out one material for another because it makes it half the price. Yes, you're making an appreciable improvement, but you're not changing anything scientifically or technologically there. So the key underpinning there is that it's through scientific or technological change. And then the last one is work that uses science technology to duplicate an effect of an existing process, material, device, product, or service in an improved way. So that's where you might see companies duplicating something that their competitor already does, where the information on how that is achievable is not in the public domain. So that's your kind of key types of advance. The other really important point about an advance is it must constitute an advance in the overall knowledge or capability in the field of science and technology, not just the company's own state of knowledge or capability alone. So I don't think this happens so much now. Definitely before HMRC increased their compliance activities, you saw a lot of projects where companies were improving their own abilities, but bringing themselves up to the industry baseline, essentially, bringing themselves up to what was already available out there. And okay, it was new knowledge for them, it was new capability for them, but it wasn't an overall advance. And it can be quite difficult to help companies kind of understand which of the projects they did actually increased overall knowledge and which ones were just them improving their abilities in-house. But it is very, very important that you're focusing on that overall advance, the overall generation of knowledge, and not just something that's an in-house improvement. Uncertainties. I'm still not sure. I've been doing R&DTax really for longer than I care to admit now. It's definitely over 10 years. And I'm still not very sure that I'm good at articulating exactly what an uncertainty is. When I used to do claims with clients, I would talk about the point where the competent professionals are scratching their heads. They've got to a point in the project where they don't know if they can actually achieve the advance they set out to achieve. Quite often, you will see projects, especially in, say, engineering companies, where the company doesn't know that there's technological uncertainty at the beginning. They're very sure they can achieve the aim. They try standard ways of doing it, and they get to a point where it's just everything has failed and they don't know how to proceed. Um, Sometimes they can say from the beginning, oh, I don't know if we can do that. No one's ever done that before. I have no way of knowing whether that's possible. But it's the point where the competent professionals cannot say whether the advance is technically feasible, is where you've got uncertainty. So if they know they can get there, but it's difficult, they know they can get there if they follow these 20 steps. If they know they can get there, but they don't have the capabilities in-house, none of that would count as technological uncertainty. It has to be where it's technically or scientifically potentially unfeasible at the outset of the work. The other key thing about technological uncertainties, the information on how to achieve the advance must not be available in the public domain. So if there is information essentially online these days, because that's where we all get our information, but there's information out there that would give you even halfway there, you'd need to acknowledge that maybe the information gets you halfway there, maybe the information can take the company all the way there. But you need to be sure that there wasn't readily available information in the public domain the company could have used to do this rather than doing their own research. And again, this does allow for if the knowledge is protected trade secret, it's absolutely fine to go away and replicate that because the knowledge isn't in the public domain. So the public domain part is the important part of that. And just to give you HMRC's definition, scientific or technological uncertainty exists when knowledge of whether something is scientifically possible or technologically feasible or how to achieve it in practice is not readily available or deducible by a competent professional working in the field. So again, it's all about that feasibility. It's also incredibly important that the work is being done by competent professionals. As you can see here, they're the ones that are judging whether it's feasible, whether it's possible, all that kind of thing. So if your client is trying to write software and they've never done it before, they are not a competent professional and would not be able to judge whether there's uncertainty and whether there's an advance. So you need someone that understands that overall state of knowledge in that area and can actually judge whether what they're doing is new. And then finally, resolutions. So this is something that isn't necessarily directly covered in the guidance. There's no kind of definition of what HMRC see as a technical resolution. I think it's one of the things they see as being easily understood. Essentially, they're looking for the company to have done technical activities to overcome the identified uncertainties. So some kind of systematic experimentation, testing, analysis, all the normal steps you'd expect to see in an R&D project. And you need to be able to articulate those step by step. It's really good to think about why they took each step. So what failed in the first prototype that meant they had to do the second one, what happened to the second one to make the third one, because that's a really good way to demonstrate to HMRC that there is that systematic experimentation and there's someone that understands why each step failed and what to do next, because again, that shows the competency of the professionals involved. I have seen the occasional project where companies are saying, well, it was really, really difficult. So what we did is we bought in the IP. So you can, much as I say, the resolutions aren't something that HMRC define or demand much about. You can completely undermine a project by saying we solved it by buying in the information. So there has to be that kind of systematic experimentation, that technical work being done. You can have the best advance and uncertainties in the world, but if you can solve them by just buying something in, then it's not going to qualify. So that's what's really important here. So that was a very whistle-stop tour of the basics of eligibility, and I think Suze now has another poll for us.
I do. Let me just get that up. Sorry, one sec. Oh, it always goes so well. Sorry, guys. I think it's because the previous poll is deciding it doesn't want to leave my screen, so it is not letting me. Jen, I don't know if you can see the poll at all.
No, I've just closed the old one, but the new one is not there.
I'm going to stop sharing that one again. We might have to come back to this one.
Yeah.
Okay, we maybe do this
That's
at the end. Let me see if I can get it up
That's
and
fine.
we'll do it at the
Cool.
end. Sorry about that, guys.
No problem. Okay, so once we have established there is eligibility there, it's time to start preparing the claim. Now, this is something that, again, we've got a whole ebook about. We have talked about many times, but actually these days it is easier because the technical narrative structure is dictated by the additional information form. And I know a lot of you will have your own reports that you attach as well. We obviously produce those through WhisperClaims, but in essence, the technical narrative, the bit that actually describes the project, has to comply with the structure of the additional information form. Otherwise, you're doubling up on the work. So you've got to know the main field of science or technology. You've got to know, so the way HMRC put it is the existing knowledge the project sought to advance. So that's your baseline, the advance being attempted, technological uncertainties faced, and how these uncertainties were addressed. And each of those sections has to be completed for each project within the claim, or each required project to say, because obviously if it's more than 10, then not all of them would be required. There's not a huge amount, I say, to say otherwise, other than my key considerations are always stick to the facts. I've seen quite a lot of over the last few years, obviously we've all seen quite a lot of inquiries. Waffle always attracts HMRC's attention, I would say. So talking about the commercial success of the company and going on at length about all of that kind of, oh, they've managed to increase revenues by this and they've achieved this and they've got this many new products. Keeps the facts, keeps the science and technology, be as focused as you possibly can, which jumps straight into keeping it concise. So each section of the AIF allows 20,000 characters. Very, very few projects. Just to be clear, 20,000 characters is about 5,000 words. So that is a huge amount. You could technically write about 20,000 words per project. That is far too much for almost all projects you'd ever be including in an R&D claim. And it, generally speaking, there is a sweet spot in the claims I see. One project is not enough. Not one project, one paragraph is not enough. 20 paragraphs is too many. So there is a sweet spot of giving HMRC enough information to understand and be convinced that the project has eligibility versus going on at length and potentially undermining it by including information that's not relevant, parts of the project that shouldn't be included. You don't want to give HMRC the impression that you're claiming for stuff you shouldn't be claiming for. Even if you feel that background is important, especially within the AIF, keep it focused, because you might distract them. You might give the impression that you're claiming for the marketing or the market research that happened at the beginning of the project. Whatever it is, if you're not claiming for it, it's best not to mention it. And then I say this about nearly every claim I ever look at is focus on the underlying science and technology. A lot of, I would say the biggest mistake I see in technical narratives is describing the functional outcomes. And that can be very important. It is important to say what the company achieved, but focusing purely on the functional outcomes can mean that you miss describing what advances, what technical uncertainties were overcome, what actually enabled the company to make those functional outcomes. So saying that you made the car, you made it 5 times as efficient as it used to be, that's brilliant. But what did you actually have to do to get to that increase in efficiency? And that can be really difficult. I often describe it as like looking under the hood, getting into my car metaphors a lot here, but looking under the hood and looking at actually what has changed under the hood, and not talking at too much length, talking too much about those functional outcomes. The flip side of this as well is that quite often the functional outcome of something is something that isn't really visible, isn't really something that customers would notice, because what you've done is make the manufacturing process 10 times as efficient, or you've managed to eke out more from the products. Whatever it is that's gone into it, all you've done is make something in a better way. But the thing at the end is the same, but there could be huge advances made in making that thing in a better way. So key thing is look at what the functional advances are and then take a step back and think about what advances were required to get to those, and make sure you're describing that within the technical narrative. I was very brief about technical narratives. I think we do have another poll, Suze. Are we anywhere close to being able to put polls up, or shall I just keep going?
Should we do the technical narrative one, and we can do the costs then at the end of the cost section? So
Yes.
yeah, so let me just quickly, sorry about that, guys.
Sure.
Technical hitch there. Can you see that? Is that
Yes, it has now popped up.
brilliant? Okay, so again, no wrong answers here. We're just looking at your feedback on what best describes how technical narratives tend to be or usually prepared within your firm. Are they built from first principles for each project? Are they adapted from prior claims and tailored? Is it a mixture of templates and project-specific inputs? Or again, is this something that you are looking to reassess in terms of your approach? Again, no right or wrong answers. There's a balance of efficiency and risk in every way that you approach this. We're just simply interested in how you're currently doing things. So yes, thank you. I can see lots of people are taking the opportunity to participate. Thank you for that. We'll just give you another couple of seconds to finish off adding your answers because I can see there's still people doing that. It looks like the third option is coming up as the most common at the minute. So like a very pragmatic approach, structure where it helps some flexibility where it matters. I think that's you all done. A couple of people still engaging. Give you 5 more seconds and I'll share the results for you all. Okay, I'm ending it now. And here are the results that you can all see as well. So Jen, any feedback?
Yeah, I think again that is what I'd expect to see. I'm actually surprised at how many people say they do it from completely a blank slate. I think that is it's an ideal way to do it. Obviously, it takes a lot more time. And I think that can be really good, especially if you're doing a very large mix of clients. If you do very, very similar clients all the time, I can understand going from templates with some project specific input, whereas obviously if your clients are very, very different, it's probably better to start from scratch. I think especially in the days of increased compliance activity, I don't think we're going to see that going away anytime soon, making sure that everything is specific, as specific as it can possibly be for each project is really, really important. So it's good to see people moving away from maybe copying and pasting. Not that I'm saying I ever saw that in the past, but I would hope that nobody on this call would ever be just copying and pasting project descriptions from any other projects. I think it also the five that have said they do it from prior claims, again, if obviously there were situations where that is what everyone would do if the company has claimed before and the projects are ongoing, then obviously you're going to take the last year's projects and adapt it. So it's good to see that mix, but I'm not surprised that the top one is using templates and project specific because obviously there are key phrases, key things you need to say for every project, no matter what. So I think everyone uses templates to some degree, whether or not they're producing the narratives from first principles or not. So that's very good to see.
Do you want to go back to our original idea of doing the polls first and then your category, or do you want to do costs and then we can do the poll after?
I'll do the costs and then we'll talk about we'll do the next poll. So again, quick whistle stop tour of qualifying expenditure and what you can include. So this is the section that has the most change, I would say. So the actual core eligibility, very little change. The technical narrative, obviously, is now dictated by HMRC, so has been the same since 2023. So like a big change and then it stayed very stable. Expenditure is the one where things have got a little bit more complicated, I would say. There's still, I'm going to talk about 7 categories of cost. I'm going to split some of those out, but the key categories are staff, externally provided workers, consumables, clinical trials, contracted out R&D. I'm using the new wording. Subcontracted R&D is what they use for the SME, and old RDEC, contracted out R&D, is for any merge schemes claims. So I will flip between the two wordings because they're essentially the same thing. Software, data and cloud computing, and contributions to independent research. Across almost all of these, well, you absolutely have to be thinking about apportionment and how you're apportioning that to each project. You absolutely have to be looking at the evidence that that spending was actually made. So looking at, if HMRC were to come and ask for, I've seen them asking for bank statements, I've seen them asking for invoices, I've seen them asking for contracts. So you need to make sure that the evidence of that spending is in place, even if you're not sending it to HMRC upfront. And then obviously for externally provided workers and contracted out R&D, you're now having to think about the overseas rules and exemptions, and you've always had to think about the connection between the claimant company and any other company it's working with. So some changes, a lot of it is the same. So I've grouped them into straightforward ones that haven't changed because they seem to be, given the time that we're doing this for, kind of keep it quick. So obviously staff costs haven't changed. Still includes salaries, bonuses, pensions, and still usually apportioned on the basis of time spent resolving technical technical uncertainties. I would say staff costs are probably the hardest one to apportion purely because unless the company has timesheets and records everything against R&D, you're relying on the company remembering, knowing, and being able to articulate how much time each individual staff member spent on R&D. So for large companies, that can be a bit tricky, but no changes at all to staff costs, which is good. Um, First subcategory consumables obviously is raw materials. So you can claim for anything used, consumed, or destroyed during the project, me including the claim. Again, no change there, completely the same across all of the schemes. The key mistake I always see people claim here is things that were bought for the project but remained exactly the same by the end of the project. So I've seen people wanting to claim for mobile phones or tablets or new lab equipment, and those can't be claimed for because they are not consumed or destroyed during the project. Much as they're used for the project, they could easily be taken and used for another project. It has to be something that has been essentially transformed by the R&D to be able to include it. And again, the apportionments on that usually a bit easier than staff because the company is usually pretty hot on what raw materials had to be thrown out because they're used in R&D and which ones went into saleable products. I'm not going to go into the nuances of prototypes and first in class here because we don't have time, but it's something that we cover in the materials that Suze is sharing with you. The other type of consumable is utilities. So water, fuel, power of any kind consumed during R&D projects. I would say generally we're still apportioning this in line with staff apportionments. I've never seen HMRC push back on that. Obviously, if the 50% of staff time is spent in R&D and the lights are on for that 50% of the time, then it would be fair to claim 50% of that. Obviously, if the company can say, actually, these R&D projects were particularly energy intensive, then you can up that apportionment. So it's a wee bit, it can be quite nuanced, but fairly straightforward. And again, no changes at all between the old and new schemes. More straightforward cost categories, software costs. So I'm talking purely software here, not data or cloud computing costs. So this is cost of software packages bought in to be used for R&D and usually apportioned on the basis of how much is used for R&D versus day-to-day use. Again, no changes there and usually pretty straightforward to do. And then clinical trials is payments made to clinical trial volunteers. So as long as this work is a true clinical trial, there's no need to apportion these costs. You can claim all of it. And again, it's not a common thing to have, but it hasn't changed at all across any of the changes. So those are the kind of 5 categories, subcategories that haven't changed at all through any of the last few years. And then categorizing them is slightly less straightforward, purely because for data licenses and cloud computing, they are only valid for claim periods starting on after 1st April 2023. Obviously, those claim periods are going to be timing out very, very soon, and soon there'll be a standard thing that you include data licenses and cloud computing. But these are near. So for data licenses, it's the cost of buying in data that's used directly for R&D activities. You can't, if you buy in data and it's an indirect thing, now that might be, I'm trying to think what that could be. If you buy in data to find volunteers for clinical research, then potentially buying in those names and contacting them is an indirect thing to do with the R&D rather than a direct thing. But as long as the data is being used absolutely for mathematical modeling, for example, then that's fine. Cloud computing is the same. So any cloud computing costs related directly to R&D can be included. Yeah, that's very straightforward. But again, those two, you're just thinking about the time period to make sure that they're valid. And then we have contributions to independent research. Now, I have, in my many years of doing this, never seen a claim that included contributions to independent research, but it is an allowable cost category for large companies claiming through old RDEC. So SMEs have never been able to claim for this, and it's only ever been through old RDEC. So that has gone away in any merged scheme claim. It's no longer a valid cost category. But if a large company has given money to a research team to do some research related to something they might want to do in the future, then potentially those costs are claimable. It is rare and it's very restrictive because it is large companies and old RDEC and doesn't exist anymore. So slightly less, not common, but also not completely straightforward. And then we could dive into the 2 more complicated. So I'm trying to make sure I cover this properly for all the different schemes that we're talking about. Obviously, subcontracted R&D. Now, again, we will be covering the nuances of what counts as contracted out or subcontracted R&D and go into more depth about overseas cost restrictions. That's our plan for next month's webinar. So I'm not going to go into that in too much depth here, again, just because of time. But in general, the rules are different in 4 different ways. So the one that everyone would be most familiar with would be under SME scheme and R&D intensive scheme. Basically, any subcontractor cost related to the R&D is allowable, and the amount that can be claimed depends on whether the companies are connected. So you've got your 65% filter for unconnected companies, but then a restriction on the types of costs that be included if they're connected. So you've got that there, and the apportionment is purely around did the subcontractor do things that were related to R&D. So quite often it is a high apportionment because it's been brought in purely for R&D. So I think everyone's quite familiar with that. We've also got old RDEC, and again, I think everyone should be quite familiar with this, where most subcontractor costs are not allowable. So this was the way of preventing double dipping under the previous schemes. You can include payments made to individuals, qualifying bodies, or partnerships made up of individuals. So you do get old RDEC claims with some subcontractor costs, but generally speaking, the rule of thumb has always been if it's a company claiming through RDEC, you can't include the subcontractors, old RDEC. I wish they'd come up with a new name for new RDEC, but there we go. So that's the old scheme. Under the new ones, costs of relevant subcontracted out R&D are allowable. So again, as long as the contracted R&D is related to the R&D project, it's not a problem to include it. However, under new RDEC and ERIS, the costs are subject to restrictions on overseas expenditure. And these restrictions are based on where the work is carried out. So you can engage with a company based overseas and claim those costs if the work is carried out within the UK. So if it's done within the UK, it's allowable. If it's done overseas, it's not. So you can see conversely, you could have a British subcontractor that physically goes on holiday and does the work. You wouldn't be able to claim for that because they're not physically within the UK. It's slightly odd, and as I say, we're going into it in a lot more detail next month. But the key thing to remember is under new RDEC and ERIS, you need to be thinking about the restrictions on overseas expenditure. And you've still got the same rules around connected and unconnected companies and the 65% filter. So there's a little bit more to think about under the new merge scheme. And finally, for Northern Irish ERIS, again, the cost of relevant contracted R&D are allowable, but the overseas cost restrictions do not apply for Northern Irish ERIS claims. This is because the claims are subject to de minimis age restrictions, so they're just restricted in a different way. So on the one hand, Northern Irish claims that use a lot of subcontractors are easier to do, but then you've got a whole heap of calculations to do around the de minimis age restrictions, so they're not any more straightforward. So 4 different ways of thinking about it, 4 different sets of rules. So you've got to be really particular now when you're thinking about what time periods, what claim periods you're claiming for, what rules you're claiming under, and therefore what subcontractor costs can be included. And the same really applies to externally provided workers. It is slightly less complicated. There are slightly fewer nuances with the rules. So under all 6 schemes that we're thinking about, EPW costs are allowable. There has to be a tripartite agreement between the claimant company, the staff provider, and the EPW for this to be a true externally provided worker situation, or for them to be actually claimed for. And again, there's the restrictions or the reduction in cost depending on whether the companies are connected or not. So whether the claimant company is connected to the staff provider. So those are universal across all of the schemes. So under the SME scheme, old RDEC and RD intensive scheme, R&D relevant EPW costs are allowable. There's no kind of differences between those 3 schemes, anything like that, you can claim for EPWs. Under new RDEC and ERIS, so the merged scheme claims, EPW costs are allowable, but they are also subject to restrictions on overseas expenditure based on the PAYE status of the EPW. So almost exactly opposite to the overseas restrictions on subcontractors, for EPWs, it doesn't matter where they are in the world, as long as they are paying UK PAYE. So you can see you could have it both ways, where you could have someone that's based in the UK but not paying UK PAYE because they're still paying through some other jurisdiction, or you can have EPWs overseas that are paying UK PAYE and therefore can be claimed for. You can also have the situation where maybe half of their income is going through PAYE and the other half is not, and therefore you'd have to reduce the amount that's claimed that way. So again, EPWs are allowable, but you need to be thinking about those restrictions. And then again, for Northern Irish ERIS claims, relevant EPW costs are allowable, and the overseas restrictions do not apply, again, because those claims are subject to de minimis aid restrictions. So as you can see, for any old scheme claims or any Northern Irish claims, EPWs are just allowed, and that's fine. But you do need to think about the overseas expenditure restrictions if you're making a claim through new RDEC or ERIS. So a little bit more nuance. It's always been slightly more complicated than the other cost categories anyway. So that is externally provided workers. And as I say, we will go into more detail around all of that in next month's webinar. So I think, do you want to run the poll that we missed now, Suze, and then I'll talk about calculating tax benefits.
This is the last one, everyone. Just a quick just poll about costs. Again, as we said before, no right or wrong answers, just interested in where you feel the most uncertainty lies when reviewing eligible costs when you're preparing claims. So is it staff apportionments, subcontractors and EPWs, legacy assumptions rolled forward, or the interaction between costs and the benefit that your client may be realizing? Got clear front runner there with the subcontractors. It's definitely one of the more tricky areas. It's not surprising. Let's give you a few more seconds to allow everybody who wants to participate to add their answers in. Very strong contender there. Okay, 5 more seconds and then we'll end it and I'll share the results. Okay, there you go. Very clear front runner there. Anything you'd like to say on that?
I'm in no way surprised, especially as I've just talked about how complicated the different things are. I would say, yeah, subcontractors EPWs at the moment, especially as people are kind of learning what is okay and what's not through the new merge schemes. It is the section that has changed the most and needs the most new processes and most new thinking about. So I'm not surprised on that. Staff apportionment, again, I think that's been a perpetual problem because most companies don't use timesheets. And I think especially again, if we're with the backdrop of the increased compliance, being able to justify the staff apportionments means that I think a lot more thought is going into that now than maybe it used to. But yeah, no surprises in the poll that subcontractors EPWs are the most difficult because they are fundamentally the most complicated area of costs for an R&D claim. Cool. Okay, I'm very aware of time, so I'm going to very quickly rattle through calculating the tax benefit. Just a quick thing on rates. So again, 5 different rates that we need to think about. So the SME scheme, the R&D intensive scheme, and ERIS and Northern Irish ERIS still all have the enhancement rate of 86%. I didn't put in claims that I think there are still some claims that could fall under 130% rate, but if I'm honest, there's so few now that we can move on and pretend that we've always had the 86%. And then the difference between those 3 schemes is in the tax credit rate, where the old SME scheme obviously was dropped to 10%, whereas the R&D intensive ERIS and Northern Irish ERIS are at 14.5%. So making sure you know the enhanced rate and the tax credit rate is really important. And then obviously old RDEC and new RDEC are both a 20% tax credit that is taxed. So it's less complicated than it seems when you spread it out in a table like this, because essentially it's either an enhanced rate and tax credit rate or it's a 20% credit. So it's a wee bit, yeah, as I say, less complicated than you think. You just need to know the way you should be applying it. So if we're looking at calculating benefit on the face of it, it's simpler now for new RDEC. We are seeing that about 72% of claims going through at the moment are new RDEC as opposed to ERIS. So most of them will be calculated this way. So it is simpler to a degree. So essentially you're looking at the qualifying expenditure. So if you've got a qualifying expenditure of £100,000, tax credit rate is 20%, corporation tax rate of 25%. Obviously, this will depend on the level of profits. So I've just picked the 25% rate for the sake of it. So therefore the tax benefit is 20% of £100,000, which is £20,000. And after tax, that's £15,000 of benefit. The complication with RDEC claims is the 7-step process that comes in when you actually try and claim it. So actually, you're going through, first of all, you're discharging any corporation tax for the present accounting period. So in this case, if the company owed more than £20,000 in corporation tax, much is it going to reduce the corporation tax bill? There's not going to be a cash payout. You're then applying the notional tax deduction. You're then looking at the PAYE cap. You then look at whether the company has any corporation tax liabilities for any other periods. You're looking at group surrender, you're looking at any other money owed to HMRC, and it's only at that point there might be a credit payable. So the key difference between new RDEC, I think, and old SME, for example, for small companies, that actually a lot of claims stop at step one. So there's actually no cash comes through. We are seeing a fair number, obviously, companies that are loss making and don't qualify for ERIS will go through this and probably end up with a credit payable. But just say that it has shifted more towards reduction in tax liability and away from paying out a cash credit from how it was before the merge scheme came in. And then actually the calculation for SME ERIS and Northern Irish benefit claims is the same as it's always been and is more complicated. It's always that, well, it depends. It depends on the P&L position of the claimant company, the enhancement rate, and the tax credit rate that you're using. So just to run through an example, and I apologise if my maths is off, I'm really hoping it's not. If the company made a loss of £150,000 before the R&D claim, but qualifying expenditure of £100,000, the tax credit rate here is 14.5% because they're assuming it's an ERIS claim, and the enhancement rate of 86%. That gives an enhanced deduction of £86,000, which gives a revised loss of £236,000. Then the maximum loss to surrender in this situation would be £186,000. So that can be surrendered for a tax credit of 14.5%, which comes to £26,970. The maximum surrender losses are the lesser of 186% of the qualifying expenditure and the unrelieved trading loss for the period. So here you can see that 186% is less than the £236,000. So again, that calculation should be familiar to everybody. I think actually the thing we're hearing most about calculations, tax comps, and actually doing claims is that some some accounting softwares haven't quite caught up with the new merge scheme yet, and some people are having problems with errors popping up and being told to ignore them and that kind of thing. But the calculations fundamentally haven't changed. The calculation for ERIS Northern Irish ERIS is the same as it was for SME scheme claims. The calculation for new RDEC is the same as the calculation for old RDEC. And actually, the only difference over those 7 steps is that the PAYE cap is slightly different. So none of this should be scarily unfamiliar to anyone when they're doing their claims. I'm going to hand over to Suze to take a breather before we jump into the Q&A section. You're still muted, Suze.
Sorry, just to give Jen a bit of a breather, I just thought it would be timely just to let you know that if anybody has been inspired today and you're not already a customer of ours on the call and you'd like to rethink how you prepare claims within your firm and would perhaps like to have a chat with us about how we can support you, you can feel free to get in touch with us directly to either or book a demo, and we can tell you a bit more about the free trial that you can see on the screen there. As Jen's mentioned a couple of times, I don't know, Jen, if you just want to flip to the next slide, we do have a couple of events coming up over the next a few weeks. First one being a public app showcase. So if anybody's not quite ready to have a one-on-one or you're still a bit unsure, on the 28th of January at 12 noon, we're going to be running a webinar similar to this today, where we're going to be demonstrating in real time how WhisperClaims can support claim preparation in practice in real time. As you can see there, we've also got information about our next training course, which is on the 10th of February, where Jen will take you through the fundamentals and the foundations of R&DTax in a much broader sense than what she's done today, because she's only been able to touch very briefly on each of the points. We run the training courses every month as well, and our events page gives you the full schedule of when and at what time our courses and webinars are. I'll just stick a little note for our events page up in the chat box as well. I think that is it. Jen's already mentioned our next thought leadership webinar is going to be on SubCon. That will be on the 11th of February at 12 noon. So we're just preparing the content now. So do look out for an invite in your inbox in the next couple of weeks. And just to clarify your question, Guy, in the chat there, the first two polls were a single only option, and then that final poll you were allowed to choose multiple choice. So I think that's the reason why the poll appeared to have more than 100% as the overall percentage of answers being made there. I could be wrong, but hopefully that's it. We will be also providing a recording of today's session in a follow-up email that you'll have with you within the next day or two as well. So yes, that's it for me. In terms of questions, let's dive in. Jenny, you ready?
Yes.
Yeah, okay.
Yes.
So first question is, thank you for that, is you mentioned that if IP can be brought in to solve the technical uncertainty, it's less likely to qualify. What if that solution is cost prohibitive, e.g. a brewing process to reduce alcohol, but without a reverse osmosis machine, which can do it, but is very expensive?
So yeah, that's absolutely something you see a lot, is companies where there is a solution in the marketplace, but it's something they can't. It is prohibitively expensive. So as long as they set out to, um, so you'd be talking about duplicating the effects of a reverse osmosis machine through scientific or technological change. So if they were to develop a way of doing that that was new and increased knowledge in science and technology and duplicated the effects of that's absolutely fine. So obviously a lot of companies will know that there's a solution out there that is prohibitively expensive. They can do it. The driver for a project being cost savings is absolutely fine. It's just that that's not an advance or uncertainty making something cheaper. The advance here, as I say, would be duplicating the effects of a reverse osmosis machine in an appreciably improved way. And the improvement is that it's cheaper, more accessible, whatever it is. So as long as there's scientific or technological advances and improvements, it's absolutely fine if the driver is cost savings or, yeah, essentially we can't afford the solutions out there, so we need to develop something that is cheaper and more accessible to us. That's absolutely fine. HMRC aren't too, they don't get too het up about the reasons for the R&D. They don't worry about if it is, yeah, it's about duplicating something your competitor's done or cost savings or anything like that. They don't care why you're doing it, it's what you've done and how that's the important part for them.
Perfect. Thanks, Dave. Hopefully that answers the question. Next one, claiming under merged RDEC, if a company has chargeable profits and a CT charge but losses brought forward, does the RDEC automatically get offset against the CT due, or can you utilise the brought forward losses and take a repayable RDEC?
I know I saw this yesterday. I know because I was looking at the 7 steps in the CIRD. I think brought forward losses are applied first, but please don't trust me on that and go away and look it up yourself. It is one way around it that I cannot for the life of me remember for definite. Um, but it does clearly state it. I just can't remember exactly what it clearly states. Within the 7 steps, it will tell you. I have this feeling that you would apply brought forward losses first, but again, please go away to and check that yourself because I can't 100% remember. I'm sorry.
Yeah, cool. Okay, next one. Thanks, Larry. Is a new technological baseline required for each year or just the project as a whole if it spans several years?
This is the subject of quite a lot of debates among R&D people. Fundamentally, the baseline is the baseline. The baseline is set at the point where the project starts. So you could argue that you can leave the baseline as is. I would say that you don't need a fully new baseline every year. I think best practice would be to restate the baseline, but acknowledge any developments in the meantime, both from the company itself and anything else out there in the wider field. Because yeah, it's fair to say this wasn't possible 3 years ago. It became possible 2 years ago, but we're still working because of this. I think that's fair. But I think if you're to help your persuasiveness with HMRC, and I hate to use the term persuasive, but you're convincing HMRC that the work is eligible, you do need to acknowledge anything that's happened between the start of the project and now. So for me, it's a mix of the two. I would say you can stick to the original baseline, but add in the work that's been done in the project so far, any advances that have already been achieved, and then anything else that's come out that impacts the direction of the project, for example.
Okay, thanks, Jim. And then last one, if anyone's got any other questions, we do have a couple more minutes. If not, this will be the last one. Thank you, Ali, for this question. How best to deal with the first accounting period of, let's say, 10 days longer than the 365-day limit of the CT600? Shall we apportion the R&D claim over 2 accounting periods?
I'm trying to work out exactly what's being asked here. So you would, if you've got a period of account that is 365 and 10 days, so 375-day period of account, you would have to split that over two CT600. So it's one AIF per CT600. So you do have to do it as two separate claims. Depending on what was done in that first 10 days, depending where that 10 days sits, you might say, look, no R&D was done in those 10 days, and therefore you're not going to claim for that period. It might be that it's too much work because you would have to split it. Obviously, what you can't do is if there was a whole load of spending on R&D in those 10 days, you can't then just move that spending into the 365-day period. So you've got to be careful about when the costs were incurred and when the work was done. But yeah, generally speaking, if your period of account is longer, then you will have to do two CT600s, two AIFs, and split the claim across the two.
Perfect. Thanks, Jen. Okay, seeing as we're near the end, I'll just do our sort of close down. But if anybody has got any other questions, we do have a couple more minutes. But it's just really to say thank you so much to everyone for joining us today, and just to re-emphasize that the purpose of today was to help everybody feel a bit more confident about things. If this session has reassured you that your current approach sounds great, then that is brilliant. But if it's prompted you to reflect on a few areas where you might want to tighten or reassess things, that's equally valuable as well. So as we've already said, if anybody would like to get in touch with us about how we can support you and your firm's R&D tax advice service delivery, you've got our contact details. And thank you again. We very much look forward to hopefully you joining us for our next session in February, if not for our app showcase at the end of the month or one of our training sessions before then. I think that's it from us for today. Thanks again, everybody. Okay, take care. We'll see you all soon. Bye.